Good morning, everybody. It's me again. So this is the first episode in my ICT series where I'm going to be teaching ICT concepts and teaching you everything I know. So the idea is I'm going to do one of these every Saturday, and then I will be doing the daily recaps every day. So from Monday to Friday, daily recaps, and then on a Saturday I'll be doing ICT concepts. All right. So the first one in this series is forming directional bias on a higher time frame, right? And I think this is probably the most important for framing your trades on a lower time frame, right? Because if you don't know what's happening on a higher time frame, how are you supposed to trade on a lower time frame and get it right? So what we need to do is frame a bias and understand how price moves. So the things we're going to talk about today are premium or discount. Are we in a premium or discount? Highs or lows within a range? External range versus internal range, and lows and highs, right? So what we want to look at is where do we sit in the most current price leg on a wider time frame. So I always start on the weekly, right? And we're looking for the most recent aggressive price leg up, and we can see it is this, right? And why have I taken this price leg? Because we've come out of a period of consolidation, right? So as we all know, price moves from consolidation, expansion, retracement, or reversal, right? That's the model we work within. And we can see that this is consolidation. So price has then expanded away from consolidation, right? So what are we then likely to expect? A form of retracement, right? And what do we actually mean by that? So price moves from a discount to a premium and a premium to a discount. That is how it moves on all time frames, right? Whether it be the weekly, the daily, the hourly, 15, 5, 2, 1 minute chart, it all works the same. Price is moving from a discount to a premium, right? And what do I mean by that? Anything below equilibrium, so anything below 50% of a range is considered fair value, right? So this would be considered a discount. Anything above equilibrium is considered a premium, right? And we know that price is going to retrace out of an expansion into a discount to sell from being in a premium, right? So we know that on this price leg, we have retraced into a discount, right? And we are then framing reasons as to why we would believe price is going to move higher, right? Because price moves from a discount to a premium, right? So if we then look at this price leg here, we are now looking at a closer period of time, but framing our bias on this price leg that we are in a discount, right? So the next thing we look at are the highs and lows that are most closest to us. And the reason being is that price moves from internal range liquidity to external range, right? So what is price most likely going to reach to, or what can it reach to? It's going to be the most recent high or the most recent low, or swing high and swing low. That's its target, right? So they become external range liquidity. Liquidity is either side of this range, right? So to help us then frame further context, we're looking at what low or high has most recently been swept for price has then moved away from. And we can see that this low was swept. So those people here who had gone long initially had their sell stops placed below, right? And institutional orders were buying those sell stops and moved price aggressively away. If price was to be bearish, we would have seen a feeble expansion here and then a collapse, right? A further continuation down. We saw a collection of longs and a good expansion, aggressive price action away, forming equal highs. We have then retraced further back into a discount within a discount, right? So we are framing our context that we have equal highs, which do not like to be sat in a marketplace. They are bullseyes. We have swept the recent lows, and we know we're in a discount of a range, and we believe price is therefore going to move higher. So we are looking for long entries to target these equal highs, and until they have been targeted, our bias is bullish, right? And we have to remember this is a weekly time frame. Yeah, this is a weekly time frame. So this is going to pan out over a period of time, but we are bullish until these have been tackled for those reasons I've just mentioned, right? So as we know, price is fractal. So it works on all time frames. Price will move from a discount to a premium and from a premium to a discount on all time frames. So as you can see, this is the same external range that was found on the weekly that is being transpired onto the daily, right? And price is retraced into equilibrium. It's retraced into a discount, albeit it's not a great discount. It's still a discount, right? And this happens to be over the Christmas period. So let's see what price does. It chops around and then price moves away, right? So price will ultimately then be looking to do what? Tackle those highs. So you remain bullish until it hits those highs. Look how many days you have between the 5th of Jan to when it actually tackles those highs, right? All of this period here, you would have been bullish. Yes, you had days in here where it was bearish, right? And you had retracements. but your context is bullish. Okay? Your context is bullish. So I hope that helps and gives you an idea on how directional bias is framed. You would then obviously be looking for entries on these lower time frames for entries higher, right? So that's episodes for later. For example, fair value gaps, order blocks, breaker blocks, mitigation blocks, rejection blocks, institutional order flow entry drills, X, Y, and Z. But they will all be covered in future videos, right? But this is the first video on how to frame directional bias. So I hope you found that helpful. If you have any questions, feel free to drop comments below. And as always, like, comment, and subscribe, or you'll definitely be off my Christmas list. Anyway, until next time, see ya. Bye.